Hi, this is Jim Cunningham, and we're going to talk about proposed tax laws for long-term care policies and how to repurpose your life insurance to help pay for a long-term care policy. This is a good one. Hi, this is Jim Cunningham. I have Shannon Behan and Alyssa Kroger with me today. We're going to talk about some proposed tax laws for long-term care policies and how to repurpose your life insurance to help pay for a long-term care insurance policy. So Alyssa and Shannon are with Ascent Wealth Management, and we're going to talk about things that frankly are near and dear to my heart. My father-in-law, who's 91, is living in a board and care. My mother-in-law passed away a couple of years ago. The cost of his care just went up about 10%. And the people who run the board and care facility, they were very apologetic. They're like, I'm really sorry, but we have no choice. So the numbers you're seeing, these are kind of going up over time, and historically they have gone up over time. But I will turn it over to you, Alyssa and Shannon. Why don't you tell us about this proposed law in California, maybe mandating purchase?
Yeah, so we'll get into this. This is just kind of a little crunchy bite to get you guys started on this whole webinar. We've got a couple slides that are dedicated specifically to this, but there is a proposed law that is currently in legislation right now to essentially require every Californian that lives here to purchase long-term care insurance. And if they do not purchase the long-term care insurance, they will be required to essentially self-fund that through the form of payroll deductions. So this is, we will get into this particular law a little deeper in a few slides.
Great. So I'm a partner at CunninghamLegal. I have over 25 years experience, and my dad, when he had over 25 years experience, he's like, yeah, I stopped counting after 25. He's a lawyer too. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities, and insurance licensed, and also a non-current pilot, single engine land. And these are the lawyers at our firm. We have currently 10 lawyers, and we are dedicated to basically all things for individuals and small business. So a lot of our clients are retired people. A lot of our people are in business. They might have family wealth. And so we help with all of those type of things. So we're not a litigation firm. We're what is called a transactional firm. And we've got here two of the four members of the team at Ascent Wealth Management, and Christina and John are not on here today, but Christine is a frequent flyer here. So Alyssa and Shannon are both certified financial planners. It's very, very important. It's a very important designation. It's who I prefer to work with as a lawyer, is those professionals with a certified financial planner designation, and obviously women. So how many certified financial planners are women percentage wise? What is it?
It's about 15% now. It's actually increased a lot over the last several years, but we're a rare office in that there's several of us here.
Yeah. And if you look here, there's a fair amount of women in our firm. My two law partners happen to be women. I'm married to a woman. So I like to be around like strong women, like go strong women. Okay. So here's our office locations. So sort of the Sacramento area, Bay Area, and Southern California, LA area. I'm a lawyer. I'm talking, my lips are moving. Don't take this as legal advice. Shannon and Alyssa are securities licensed, and don't take this as investment advice. It's the farthest thing from it. So just to clear the air on that. And all guarantees are, why don't you cover this? What is this, another disclosure, right? That they make you do?
Yes, it is. Any guarantees are backed by the claims paying ability of the issuer. All examples are for hypothetical and illustrative purposes only. Always consult with your financial professional about your individual circumstances. This is strictly hypothetical in nature. We show a few case studies here in the slides. So certainly we can always evaluate custom solutions to your particular scenario, but none of this guarantees anything to each individual.
Yeah. And it's really important, that first line there, the guarantees are backed by the claims paying ability of the issuer. I think a CalPERS, when they undercharged people for long-term care, and a lot of CalPERS, we have a lot of clients who are state employees, and they're like, hey, my premiums are going way up and the benefits are coming down. What's the deal with that? Because they made a miscalculation, and that was from a long time ago, but I think the industry has learned quite a bit. So let's talk about the burden of on the family. I mean, 83% of care is provided by family members, right?
Right. So most often care is provided by an immediate family member or an extended family member. Actually, majority of care is provided by the female in the household. If you have sons, I'm sorry, you're kind of out of luck. Typically, care is not given by sons. If you can, actually 8% are sons. The vast majority are the spouse, the female in the relationship. And actually only about 25% of men outlive their female counterparts. So likelihood that there is someone in the household that can actually provide care to a male spouse is likely, because they're typically the ones that go first. And then the female is usually the one that's the widow or the widow that's remaining and surviving. So really looking at care for a female is critical, simply just because there's not necessarily someone there to take care of them after their spouse passes away. So 75% of care is given by female, and majority of people don't ever want to be a caregiver. It's kind of one of those circumstances, Jim, that you probably see with even just estate planning. People don't want to be trustees, or they don't want to ever leave a family member to that responsibility until they've themselves served as a trustee. Long-term care doesn't become a topic of conversation or discussion for people often until they've themselves served as a caregiver, and they don't want to become a burden on any of their family members.
Yeah, my grandmother took care of my grandfather for a long time, and then she died and he lived for like another 3 years. So go figure. And this is to your point, that the family members who are the primary caregivers on average have a shortened life expectancy by 7 years, because it's hard. And a lot of times these are older people caring for older people, right? It might be a wife caring for a husband, and they might be in their 80s, and it can really wear you out. That was the case with my grandparents. It can really, really wear you out. So
right. Just keep clicking.
yeah. So men, they're lucky if they get 2.2 years, right? No, I'm kidding. Right?
Yeah. So all of these facts are just on average, typically people are going to need between, 2 and 4 years of care. Alzheimer's and dementia is a big one. A lot of people don't think that it's going to happen to them, but majority of people needing long-term care for extended periods of time are those that have Alzheimer's and dementia, and they need it for an average of 8+ years, because your body may be functioning fine, but your mind is not fine, and you need full-time round-the-clock care. This is the most expensive type of care as well. It's 24 hours round-the-clock care for people that have a cognitive impairment like Alzheimer's or dementia. And so that's a significant area of concern that's often overlooked for people, because 1 in 3 seniors actually dies from it.
Yeah.
So,
and I'll tell you, in my case with my in-laws, my mother-in-law was in a nursing facility at the end of her life with advanced dementia, and she suffered for that for many years. My father-in-law now is in cognitive decline, and he's in an assisted living facility. They lived for many years, kind of taking care of each other. And we kind of talked about like them leaning on each other, right? Like alone, they couldn't stand on their own feet, and they kind of muddled through there for a period of years. But this is real. And, if you're watching this and you're like, oh my gosh, this is my parents, or I'm afraid this is going to be me, this is something to plan for. And I will tell you, it's something that it's a very stressful part of time to go through in your life. You're going through it in a period of time when you yourself may be in cognitive decline a little bit, and you have to take care of somebody else. It is a tremendous burden on some family members, and it brings out, I will just say personally, it brought out these issues of that my brothers-in-law had about their parents. And it's just, it's this weird phase of life that planning for it and looking to ensure some of the downside risk really helps.
Yeah, we actually have a mutual client, Jim, that had early onset Alzheimer's in his early 80s, I believe, and he was in care for 19 years. No, so it wasn't early 80s, it was 70s. That's right, 70s, and needed care for 19 years. I think he had over $2 million of claims paid out on his long-term care insurance policy,
Wow.
and his family members were thanking their lucky stars that he had it, because that's a lot of money.
Oh, it is.
Yeah, Alyssa, I think that brings up a really good point in terms of a lot of the times when we do planning, we talk about life expectancies and average life expectancies. But I think there's a really important distinction between a life expectancy on average and the potential for longevity, right? People are living longer. They might not be as healthy in their later years, but we're at least able to keep people alive and care for them in ways that we wouldn't have before. I just saw actually the Social Security Administration came out with new statistics on the probability of people living into their 90s. And for 65-year-olds today, it's 53% probability that a man will live into his 90s and 62% that a woman will live into her 90s.
Yep. Yeah, 74% of people over the age of 65 are women. So, and those that live into their 90s, the vast majority of them are women. So this is a sobering reality. Really, it's 70% of people will need long-term care if you've lived over the age of 65. And one of the largest burdens financially is long-term care, an unfunded long-term care need. And the reason for that is just cash flow. Most often people, when we're planning for retirement, to Shannon's point, we're planning from a life expectancy standpoint, we're planning for longevity, but we are also planning for just basic cash flow needs, lifestyle needs, making sure all of your mortgage and your medical and things like that are all paid for. But a long-term care event is essentially an outlier. It's very likely to happen, but it is an outlier to your basic necessities and basic lifestyle needs. And so everything that you pay for in retirement is after tax, or after tax money, essentially is what your basic needs are. If you have an IRA, obviously you're paying tax on that. But long-term care, if you don't have a long-term care insurance policy, you're essentially paying for $5,000 of monthly needs for long-term care after tax. So you're paying the federal government and the state government first, and then using after-tax dollars to pay for this care. So you're essentially having to pay potentially a 30 or 40% premium just to get those funds out. So a long-term care policy can be utilized tax-free. And so it helps alleviate that additional premium that you would otherwise pay in tax.
I want to talk about this Medicare and Medicaid has me covered, and this is Medi-Cal in California. I would say the biggest barrier, Medi-Cal is changing and they're really expanding Medi-Cal, and they're looking primarily now at income. They're going to be disregarding assets in the not too distant future. But the first thing you have to do, qualify to get on this, any state benefits. First of all, Medicare is limited in time to 100 days a year. But Medi-Cal, or the Medicaid system, you have to qualify medically. And what that means is you have to need to be in a skilled nursing care facility. Now, if you've ever been to a skilled nursing care facility, you probably don't want to go there. So that's the facility that you have to go in, and you have to medically qualify. And just because you have a cognitive impairment, just because you have activities of daily living that you can't bathe or toilet or whatever it is, does not necessarily mean that you medically qualify to live in a skilled nursing care facility. So it's something really important. This is, I would say, probably one of the most complex planning areas. That and partnership taxation are kind of equal, because there are a lot of variables here. But I think there is denial. I will tell you, Alyssa and Shannon, when I meet with a client who has gone through this with their parents, right? They say, yeah, I want to get some long-term care insurance.
Absolutely.
Because it's just stressful to even think about it.
Right. It's back to what I said is a lot of people don't ever want to think about long-term care being a reality for them until they themselves have served as a caregiver.
Yeah.
It's a harsh reality, and it's certainly not fun to have to be a caregiver. I mean, like you said, you're experiencing that right now. It's just, it can be a life suck, truly. It takes every bit of energy and time out of your day. So it's certainly something that you want to think about with regards to your family members. Not
every moment. And my wife does watch these from time to time, but she does get like 19 calls from her dad in one day. Like, how come you're not returning my call? Dad, I just talked to you. So, but anyway, he's a great guy.
Yeah.
So average, what is average? Average, we take all the possible scenarios, and the point is, this is a big number. It's not a small number. This is per month. This is
correct,
not
per month.
Right.
Right. And this is in California, and this is based off of, there's a website, it's Genworth Cost of Care. You can go onto their website and look it up yourself. For any state in the nation, you can actually look up the average cost of care, and they even get so granular as the zip code that you live in. So you can actually look this up and see what average cost of care is for even your loved ones if they live out of state and it's not applicable in California. But generally speaking, the range is anywhere between $5,000 and $14,000 a month, depending on the level of care that's needed. So that's where you get that kind of $12,000 average cost.
Yeah, yeah. And Alyssa, this is really important. This is geographically specific. So if you're in Palo Alto, you're going to pay more than you will pay in Sacramento. But I can tell you right now, the going rate is not $5,200. This is from 2021. We're in 2023. It's about $6,500 a month. So this has gone up. You've heard a lot of inflation in the news.
Right.
And I think that's one thing to really think about is the inflation of this particular service. So Shannon, when you do model out plans for clients, we're not blind to inflation. We have to factor it in, but this inflation is going up more than regular inflation historically, right?
Absolutely. Yeah. Medical expenses, just cost of care in terms of facility care, but also just medical expenses outside of that, paying providers is one of the fastest increasing expenses that we see for retirees.
Yeah. And I saw there's a proposal I saw in the news last night in California to raise the minimum wage for healthcare workers to $25 an hour, which if you're a healthcare worker and you're making less than $25 an hour, it sounds like a good idea and we can debate the merits of that, but that will result in this number going up, quite frankly. So that's not going to be 12,000. It's going to be a number that's higher.
Right.
So
I'm curious what the 2022 numbers will actually post. At the time that we're doing this webinar, it's way too close post 2022 to see what those numbers would be. But because we had so much inflation in 2022, I'm very curious to see what the impact is on these costs.
Yeah, it wouldn't surprise me if these were up 10 or 15%, quite frankly, getting close to 14,000. So that would be my supposition. So yeah, talk about ADLs, right?
Yeah, what qualifies you for long-term care? Certainly activities of daily living is what ADL stands for. That's the acronym. And cognitive impairment of any kind is essentially a first and foremost knockout. You don't have to worry about having two to qualify. You just need that one in order to qualify. And more often than not, the carriers will allow your doctor to qualify you for the need for long-term care to go on claim. The other activities of daily living are bathing, dressing, eating, transferring, moving from bed to chair, using the toilet, and maintaining continence. So those are the general activities of daily living that they will look for to qualify you for long-term care. You have to have two of them, or cognitive impairment will stand alone on its own to qualify you for needing long-term care or to go on claim.
Yeah, and eating's an interesting one because I don't think eating is like inability to chew food, but I know with my mother-in-law, we would have to prompt her to eat. Okay, well, put the fork in, or you might actually have to, feed them with the fork because people lose that ability. It's very sad, and people lose that ability to connect hunger with food and all the things that intuitively we know how to do. So, but I would definitely encourage you, if you're watching this and you're like, wow, those AD activities of daily living, you can Google it, take a look at it, and they explain what all those are.
Right.
So how do you pay for it? How do people typically pay for it? Let me ask that.
Typically, people pay for it from their own assets. So that's generally speaking the crutch that people look to. Oh, well, I've got, X in the bank. I can certainly afford to pay for long-term care and self-fund. I don't need insurance. Well, Warren Buffett has insurance. And the reason why is because he understands the value of leveraging every single dollar that you put into an insurance policy and transferring that risk to the insurance carrier rather than his own portfolio. So even the wealthiest of the wealthy have insurance, and they understand the advantages of transferring that liability or that cost to the insurance carrier. So that's more often what we see is people wanting to rely on their own assets or what they have as far as their nest egg. But to Shannon's point, you don't know how long you're going to live or how long you're going to need these assets, and things happen, not just long-term care events, other things happen, roof falls in, or, you might have, one-time lump sum events that do drain your assets, or we have a market year like last year. So, the worst that could possibly happen would probably having a market year like last year and also having a long-term care circumstance, draining those assets in a down market. So That's more often what we see is people relying on their own assets or government. It's that misconception that the Medicare, Medicaid will cover the cost of needing long-term care. And that's a very big misconception, because you do have to qualify, and there are a bunch of hoops to go through in order to qualify for the government to pick up that cost. And do you want to have that level of care?
Yeah, another interesting thing is, by the way, this is Medicaid. There's Medicare, which is federal. There's Medicaid, which is basically healthcare for poor people, funded by the federal government in partnership with each state. So unlike Medicare, which is not as state specific, Medicaid is really state specific. And so what that means is, if you're in California, California has very generous Medi-Cal benefits. Now, Medi-Cal in California is the word we use for Medicaid in California is Medi-Cal. In Arizona, it's called Access. In most other states, it's just called Medicaid. But it's very important to understand that if you're looking for long-term care benefits in California, the rules are different than in Nevada, than in Utah, than in Colorado. California has the most generous benefits, frankly. California, probably New York, have the most generous benefits. So it's something really to pay attention to. It depends on where you are when you have this need. So really pay attention to that. Glenn asks a great question. Glenn asks, can you buy a long-term care policy and fund it with your IRA account? What are your comments on this?
You would not want to fund it with your IRA, simply because your IRA is all pre-tax dollars. So certainly anything that you pull out of your IRA, you're going to pay state and federal taxes on, depending on where you live. If you live in a no income tax state, then you won't have as big of an issue as you would in California. But pulling the money out of the IRA is certainly not advisable. We always typically look to non-qualified assets or repurposing other non-qualified assets, which we'll get into in a couple slides. If you have, for instance, an annuity or additional trust assets, individual accounts, things like that, we would look at those first and foremost, because you've already paid the tax on those assets, and repurposing those for long-term care. But
let me just say, so Glenn, you asked a great question, because that requires, whether you can or can't, is that best for you? And that's why we talk a lot in these webinars and videos about getting your A team together. So you get your CPA, your financial advisor, and your attorney together, all working with you. And it may be, theoretically, it may be the best thing to do for you, might be to take money out of the IRA and buy the long-term care insurance policy. I don't know. It may be the worst thing to do, but I think that's something that's very hard to answer in a vacuum. And that would be a reason why you would want to reach out to somebody like Shannon or Alyssa, because they've got the background on this, and they can look at these other options rather than somebody who's solely focused on just this one particular thing. But let's talk about what's going on in Washington State. So a lot of people in California, a lot of people leave California. That was in the news, how many people left California. Some states don't want people to come from California anymore, like Utah. They said, please, no more. But let's look at this other state, Washington. A lot of Californians oftentimes move to Washington. There's no state income tax. Something to bear in mind is there is a death tax in Washington. If you have just over $2 million in assets and you're a Washington resident, poof, it's a 20% death tax. So kind of a big deal. No income tax, but you do have this potential death tax. But tell us what's going on in Washington, why they're doing this, and what's the deal in Washington now with long-term care?
Yeah, so I think the why is because of all of the reasons that we've talked about so far. It's a huge problem. It's one of the, as Alyssa pointed out, biggest reasons for bankruptcy. It becomes a burden on the states if people are, relying on their Medicaid programs. So I think that's the why around it, is to try to put some sort of safety net in to make sure that this is an expense that's funded to some extent. So what Washington did, it began in 2020 and into 2021, was implemented this new law that essentially mandates that every Washington resident have some sort of long-term care protection. Now, for the bulk of people, what that will mean is that they're participating in the state program, and that's funded via a payroll tax. And that payroll tax is 100% on the employee. So there's no employer contribution in this whatsoever. It's 100% on the employee. They pay into this fund over the course of their working years while they're in Washington. Anyone, 18 and above that is working in Washington is paying this tax unless they have an exemption, which we'll talk a little bit about what those exemptions are. But they're paying this tax. And what that gives them access to is then in the future a benefit, which is not a very big benefit at all. So to give you kind of an idea for Washington's program about how much it's costing people, if someone was making $250,000 a year in Washington, their contribution annually into this program would be about $1,500 a year. So this has kind of been the guinea pig. A lot of other states are starting to talk about this now. And I'm actually kind of glad Washington went first and that it wasn't California, because there's definitely been some issues with this program that have come up. I think for me, one of the first ones is really the fact that it's creating this sort of false sense of security around, oh, there's a program in place now. Don't worry, I've got long-term care through the state. There are, obviously, each state would have a different law, but for Washington's, the maximum benefit for this program is $36,000 for a life over the course of your lifetime. And we just looked at those, average cost of care numbers. That's not going to get you, very far in terms of monthly expenses, especially when we look at the statistics around if someone does start needing long-term care, how long do they need that care for? Over 60% of people who need long-term care, who go into custodial care, are using that care for more than 3 years. So $36,000 is not getting us very far, first of all. And then really kind of a second issue that came up was you are able to get an exemption from participating in this program, paying that payroll tax, if you have private long-term care insurance. And so and the window for kind of proving that you had long-term care insurance in place was just over a year. And so we essentially had an entire state looking at buying a long-term care insurance policy in 1 year. So carriers were absolutely overwhelmed with applications. The bottlenecks were huge. They started just rubber stamp denying applications that came in because they just did not have the capacity to offer these plans and to go through the underwriting that was necessary. So it really kind of created a big problem in the private long-term care insurance space. And ultimately, I think it just put a bad taste in people's mouths. Some other problems that came up were, you pay into this plan over the course of your working years in Washington. And then what if you decide you want to retire out of state? Yeah. Well, you've now paid into this benefit that you can't collect on because you have to live in Washington in order to collect on the benefit. Or what if you're 2 years out from retirement? You're paying into this, but you don't meet a 10-year window for paying into it, so you can't collect the benefit. So there's all these hurdles that have come up that are, they're trying to find workarounds and resolutions, but it's been a tough go of it in Washington, certainly.
So Richard asks, is the Washington plan mandatory? Well, Richard, I think the answer is it's effectively mandatory because if you don't do it, you have a payroll deduction. So in that sense, it's not, the payroll deduction's mandatory if you don't have private long-term care, but this is for people who are getting a paycheck. So this is not for people who are already retired or who do not receive a paycheck.
Right. There is an opt-out clause. There was an opt-out time frame given where people can go and get their own long-term care insurance. And if they did it within that time frame, between October, I think they had about an 18-month time frame. And that's what created really that bottleneck that Shannon's talking about, is everybody went out to try to go get a policy to hit that opt-out because $36,000 is not enough. And most people know that it's not enough. And so they were scrambling to go get their care. And if we saw this happen in the state of Washington, population-wise, California, I don't know how much larger it is population-wise than Washington, but quite significantly being one of the largest states in the union.
Yeah. The other thing too, to understand, if you're watching this and say, well, Washington insurance, you can't use it if you leave out of state. Why can't you take it with you? This is the way insurance is structured in the United States. There are no federal insurance companies. These are all done state by state by state. So each state is its own like country almost when it comes to insurance, and insurance companies are licensed in a particular state. They're licensed to do business in a particular state. So this is why if you're a business owner and you say, oh, this is making sense because I have employees in California and Nevada, and they can't be on the same healthcare policy, right? It goes state by state by state. So that's just something to understand. There's no federal, at least yet, no federal. Now that would be an interesting one. If there was a federal, like, hey, people need to pay even more tax, right? Just take money away from people who desperately need it, who are working, right? So these are the places that are considering it, huh? Wow.
Right.
Yeah.
So everything in red is wait and see. They're kind of just testing the waters, but proposed legislation is, you'll see the yellow states, New York, Pennsylvania, California. Those are for real happening. It's in the state legislators' laps right now, and they're working through some of the kinks that happened up in Washington to fully potentially put this into law.
So obviously, us being here in California, we're paying a little bit closer attention to what's happening here. Where it stands in this state is that they have identified 5 potential plans that they've got out to a consulting firm now to kind of evaluate the cost benefit analysis of those plans. They range anywhere from benefits of the similar $36,000 to Washington's plan to all the way up to $144,000 over the course of 2 years. Both the board and the public that they surveyed like the $144,000 total benefit. So if I had to speculate, I would think that California's payroll tax is going to be higher than the one that Washington has. They've even been throwing around the idea of having employers participate as well. So that's, if you're a small business owner, something to keep on the radar there as well.
And there may or may not be a cap on salary deductions, meaning Social Security is capped at a certain point based on your earnings. There may or may not be a salary cap on how much you contribute based on how much you earn in the state of California for contributing to this program.
And by the way, if you're watching this and you're thinking, well, doesn't Medicare cover this? Medicare covers here's kind of how it goes. You trip and fall, you get taken by the ambulance to the hospital. It's like $10,000 a day at the hospital or whatever it is. The hospital desperately wants to get you out of the hospital and get you into rehab. Medicare typically pays that rehab. It's about $1,000 a day, so it's a little bit less. Once you stop improving, that's when you get discharged to the skilled nursing care facility, and it might be $300 a day or whatever it is. But you can see how this goes down. They kind of want to push you as a patient to the facility that is the least on a per day charge. And by the way, that skilled nursing care facility typically is private pay. So unless you're poor and on Medi-Cal, you're not going to qualify for that. So Medicare does cover that rehab. You typically have to be improving. Once you plateau, they kick you out. And that's limited to 100 days per calendar year. So a maximum 100 days. I have seen one client in 25 years spend 100 days in one of those fully utilize their Medicare benefit. It rarely happens. So the great retirement income gap. What are we talking about here?
This is what I had touched on earlier. It's when we do a lot of planning, we look at basic necessities, basic income needs to meet your lifestyle in retirement. With the exception of an outlier, we do, of course, look at long-term care and evaluate the potential for a long-term care event. But more often than not, it does go overlooked in the sense that this is a real problem and it's a real thing that happens. And if there is some sort of an Alzheimer's diagnosis, what is the impact on your actual retirement income? What is the net effect to you, especially since you potentially could be self-funding and using after-tax dollars? It can drain assets quite significantly and quickly.
Yeah, great slide. This reminds me, the analogy I use with clients many times, Shannon and Alyssa, is like, you're going to go on a journey of an unknown duration. It's like you're going to do a road trip in your car, and assuming you still have an internal combustion engine car, you want as much gas in that tank because you don't know how far you're going to go. And that's your savings, right? And then then you have your income. And when you run all these numbers and you look at what you're spending, that's what Alyssa and Shannon do. Frankly, I think for a lot of your day, isn't it helping clients figure this out? It's like, this is my retirement income. These are my assets. This is what I want to do in my 60s and my 70s and my 80s. How do I even budget effectively for this? And these are big, stressful decisions. And Abraham Lincoln said once, if you represent yourself, you have a fool for a client. So I think a lot of people try and do this on their own, but I know when I try and do it on my own, and I do this stuff pretty much every day on the legal side, I can't figure it out, right? If it's for somebody else, it's fine. But when you're thinking about yourself, it can be extra stressful.
Yeah, Jim, we're the same. We plan for each other. We don't even try to take our own financial plans into our own hands.
Right.
All right. So single premium. So the old way, and you had a slide on this before, the old way was pay monthly, $500 a month, $1,000 a month, $250 a month, whatever it is. And if you use it, great. And if you don't use it, you lose it. So it's you use it or lose it, and you pay monthly. And many of our clients, I did mention CalPERS at the beginning. Many of our clients run that CalPERS pay monthly, and they said, gee, we miscalculated. So we're going to have to raise your premium a lot or cut your benefit. And you've already been paying into this thing for years, which I think was really unfair to the policyholders in that sense. But talk about what a single premium is.
Sure. So it's an alternative to that use it or lose it old case scenario. A lot of those older policies are great policies, so we don't want to rag on those too hard. But there are people that do hold them, and they are still very strong policies because they have 5% compound inflation and so on and so forth. But this particular case study is a 65-year-old female using a lump sum premium to fund, never pays another dime into this policy, just funds it initially with $100,000 premium. And you'll see that there's a $67,000 death benefit. And the reason why there's the reduction there is essentially that portion, that differential, is going to pay for the cost of insurance over the lifespan of the client at 65. So that's why it's a little bit reduced. So you don't get your full premium back if you were to pass, but that's just the cost of potential insurance. And that's the risk that the carrier is willing to take, in the sense that you're covering that risk transference of the amount of roughly $33,000. You'll be able to utilize the death benefit and accelerate that actually down at a 3% per month acceleration, which equates to that $2,600 per month. And that'll last you about 25 months if you were to do that. And you essentially eat through your death benefit first. And then anything after that point is 100% guaranteed on the insurance carrier's dime. And they will pay up to $32,000 a year in coverage, no matter how long you need care. So a lot of clients like this particular structure that are concerned specifically for having insurance for insurance purposes sake, or concerned for a long-term care event like Alzheimer's or dementia, where you might not have an idea of how long you would need care. This will cover you for extended periods of time, no matter how long you need it.
Yeah, and to give context, for those of you who might have, if you're looking at this and you go, yeah, I have this permanent policy with a cash value, maybe it's $100,000 cash value, and I bought this policy 30 years ago to replace my earnings, right? If I had an early death, well, now you're retired in 65 and you go, I'm retired. I don't need life insurance to replace my earnings because I've already earned them. What we're talking about is repurposing life insurance. And I think you'll probably explain this in a couple of slides, but you can take that policy and do kind of like a tax-deferred exchange you do with real estate, a 1031 exchange. It's a 1035, which refers to the Internal Revenue Code. So this is sort of that repurposing of life insurance. And this is just one example. And, this is not how all policies are written. This is just one particular case. Kathy asks, eat through death benefit first. Can you address this again? So I think the question is, just make this like really simple. Or this person here, this lady gives $100,000 to the insurance company. And if she died, I don't know, 6 months later, her kids would get $67,000, right?
Right.
Okay. And then if she buys this policy and a year later, she goes up, I've had a stroke or cognitive impairment. What is she going to get per month? Is she going to get $26.98 per month?
She'll get $26.98 per month until she's depleted that $67,500 of death benefit. If she passes away right after she depletes that, there's no death benefit for her heirs. If she depletes that all the way down to zero and she still needs care, she has care for as long as she needs it for until she passes away. There just won't be a death benefit associated after she's already bled through that $67,000.
Yeah. So let's say she buys the policy, puts in 100,000. She has a stroke and she's needs this for 6 months. So she goes through 18,000. Does her family get no death benefit, or do they get
prorated amount goes to the beneficiaries?
Yeah, 67,000 minus the 18,000. Okay. And again, this is just one way of doing it. There are other policies that look different, but they're just, these insurance companies are smart people. They're not dumb people.
Right.
But it's what's right for you.
Right. This is another case study. We can always do joint policies. This is a $200,000 single premium. You'll see that reduction in death benefit just because it's paying essentially that cost of insurance right up front for the extended period of time for 2 lives. Similar structure, you can accelerate down that death benefit at a 3% per month. That equates to about $4,300 a month per person for just under 3 years. And then once you've gone through that $146,000, both people will be covered at that $4,300 a month or $8,700 a month joint coverage per month until the day that you die, no matter how long you need care. So even if one spouse needs care for 5 years and the next spouse needs it for 10 years, it'll just continue to pay out up to a $4,300 benefit per month per person until both pass away.
Joy has a great question. Joy says, on this one, but $32,000 per year doesn't really help much, ? So it doesn't really help. Here's what I would say. This is basically to explain a concept. And Joy, for you, it sounds like 32,000 isn't enough. 2 things are going on. One thing that's going on is you still have your retirement income. So what we're talking about is the difference between what your needs are plus that added long-term care expense. So it's your expenses going up. You still have your income, but for you, 32,000 might not be enough. You might want to put in 200,000 so you get 64,000 annual coverage. So it really just depends on the individual person. But Joy, you make a great point, and I think it highlights that this is not one size fits all. And it's kind of funny that, talk about one size fits all, the Washington plan, right? Like that's just why
the
are
other
they
thing I
doing
would point
this?
out too is that both of these examples are people who are 65.
Yeah.
We can start planning earlier as well. This is a conversation that we should have earlier. If we, get into a policy earlier, we're able to leverage those dollars a little bit better and get a bigger benefit oftentimes. So you're never going to be, younger and healthier than you are today. And that means cheaper to insure.
Right.
Yeah. Let me just, before you talk about an annuity, here's what I'm going to make clear. We're not proposing that you buy an annuity. Okay. This is not what we're talking about. This is if you already have an annuity. Okay. And what an annuity is it's a contract. And if you say, hey, I put in $100,000 and it's tied to the S&P 500, that money probably is not invested in the S&P 500. It's just a measuring stick. It is really no different than saying, hey, if it rains on Tuesday, you get 5% return. They just have to have something that's objective so that they can forecast and figure it out. But it's very important to understand annuities are a contract, meaning any gain in the annuity is taxable as ordinary income. And this is really, really important because if you have an annuity and you're a high income earner, these can be very taxing when it comes time to pull the money out. So teed it up with this, I'll let you take it from here.
Sure. So this example here is just showing if you do have a non-qualified annuity that you maybe don't need or don't know what to do with, you can essentially lock in that gain that you've had. So for instance, you put in $100,000 15 years ago and it's now worth $300,000, and you don't want to have to pay the tax on that gain. If you were to take that out of the annuity contract, you can repurpose every bit of that gain. So the full $300,000 contract value, you can repurpose that into an income tax-free bucket onto a long-term care policy that is on an annuity chassis. So it's essentially an annuity for an annuity, but you're using that as a tax-free way to fund your long-term care because you maybe don't need this other non-qualified annuity that you don't know what to do with and you can't get out of because you've got too much tax burden. So this is an opportunity to essentially fund a gap in your plan for long-term care without having to pay that tax through the form of what's called a 1035 exchange.
Yeah, this is a great way to take something that is taxable and make it tax-free. You know, there's a bit of an if then in there. You have to have the need for it, right? The long-term care need.
Right.
But this is a great way. And again, this kind of highlights why it's important. You know, Shannon and Alyssa, I got to tell you, I'm continually impressed in working with you, the depth of your knowledge. Like you'll see things that, you know, lawyers have specific training, you have specific training. We're working on similar matters together quite often, or client matters. And you guys bring so much value to the table. A lot of times you're able to point things out that's like, well, I never thought of that. And it really does help the client. So this is a great one. If you have a non-qualified annuity, which is an annuity outside of an IRA, outside of a 401k, outside of a TSA, tax sheltered annuity, outside of that, right? This is like if you own it and you're the owner, so it's not in a retirement plan.
Right. And I wanted to touch back on, I think it was Glenn who asked the question regarding the IRA. There are ways to do essentially what's called an IRA strip out. And to Jim's point, every situation is unique to each individual. We can look at your plan and all of your assets holistically and say, we can satisfy this need with the assets that you have. So not everyone has non-qualified assets.
Right.
Not everyone has a non-qualified annuity. You may have an IRA and you may be staring down the barrel at significant RMDs by the time that you hit 73 or 75 per the new Secure Act rules. And we can do a strip out strategy where we're essentially taking a little bite-sized chunks out of your IRA, paying the tax now, and funding a policy that has multiple uses, such as long-term care for later down the road to help alleviate some of those RMD concerns later. So again, kind of going back to the CFP, Certified Financial Planner, these are things that we can look at, that we can catch by looking at your holistic plan.
Yeah. And by the way, strip out for if you're watching this, go, what are you talking about? That's where you have an IRA. When you hit 72 or 75 and the law is changing and it depends on when you take the money out, money has to come out of that IRA at some point in the future. And what ends up happening for many people is they get pushed into a significantly higher tax bracket in their 70s. Okay. What we're talking about is maybe you've retired and you're 65. You're not earning any money. You're not even taking Social Security. You're not making any money. You're living off your savings. That strip out strategy is where you take some money out of the IRA, okay, and pay it at a lower tax rate. So this is tax bracket arbitrage. And this is something that most planners, should know. Too often though, they either know and they don't do anything. They don't advise their client, which I think is the worst of all, or they just flat out don't know. Anita asks, would it be wise to start applying RMD required minimum distribution now if required to do a long-term plan? So does it make sense to pull money? I think that's a strip out strategy Alyssa and Shannon, you were talking about.
Right. Yep.
And we have, by the way, we cover a lot of this stuff, like the strip out strategy, tax bracket arbitrage. Go to our YouTube channel. We have a whole channel related to financial stuff. And we've got a lot of content, a lot of videos on there. So female, age 65 with a $100,000 1035 exchange premium. That's Internal Revenue Code section 1035. So for the lawyers watching this and the people who even know what a 1031 exchange is, that is a tax-deferred exchange of real estate. This is a tax-deferred exchange of a life insurance policy, which I think a lot of people don't even know exists.
So this is looking at if someone has a large life insurance policy, maybe their needs changed and they've got a bunch of cash value sitting on a life insurance policy and they don't know what to do with it, and want to repurpose it, don't want to pay the tax, don't have the need for that life insurance because your kids are grown, you have no mortgage, you have no debt obligations to replace income, so on and beyond all those types of things that you would initially buy life insurance for. But now your needs have changed because you're older and you're potentially looking at a long-term care need. You can actually repurpose that cash value that's sitting on an existing whole life insurance policy or permanent life insurance policy and exchange that in the form of a 1035 exchange and put that in as a single premium of $150,000 in this particular circumstance onto a life insurance with a long-term care rider. That's the ability for you to access that $512,000 while you're living for long-term care should you need it. Now that death benefit's there like a traditional life insurance policy if you don't need long-term care. So if you pass away, never need care, that death benefit's there to go to your beneficiaries. But more often than not, you don't want to deplete 512,000 of your assets while somebody is alive just to eventually get replenished after they pass, because that could have more of a long-term effect on your overall assets or financial plan. This allows you to tap into that death benefit while you're still living if you need long-term care, to the tune of about $20,000 a month. And if you did deplete it at 4% or $20,000 a month, that would last you just a little over 2 years in care in this particular circumstance. So that's a huge benefit. I mean, that puts essentially an umbrella of 500,000 over your other assets that are covered by this particular policy before you even have to tap into your assets. That's a huge savings, a huge cost savings just by repurposing something that you already own, that you've already paid for.
Yeah, I mean, this is a great example. And this goes to Joy's earlier comment was like, well, 36,000 a year isn't that much. Well, 240 is better. 240,000 is better than 36,000. So Joy also asks, is this strip in addition to the required RMD? Typically on a strip out strategy that's pre-RMD typically. Is that correct? Yeah.
Right. It certainly is using the time frame, the runway of time between now and when you are required to take RMDs, that we are looking to deplete those big tax deferred assets and use them in a different way.
Annie asks, I'm 79. I'll be 80 this summer. I don't have long-term care insurance. I'm healthy and have no family history of Alzheimer's, cancer, etc. How do I know what I need? This is very confusing. Annie, I would reach out to Alyssa and Shannon. We've got information on how to reach out to you. I don't know if you want to just call out the phone number they can call, but I would definitely reach out to them. And maybe Ashley, if you can put the contact information in the notes for Alyssa and Shannon, so they've got it. I know it's on a slide here a little bit later.
It's the next slide, actually.
Next slide. All right, we're almost at the end.
Yeah, we're almost done.
Anonymous asks, will you ballpark hypothetical costs of the most popular insurance policies you can offer us? I have no idea and would like to hear the ranges of cost. It's kind of like, how long is a piece of string?
Yep, it really depends. There's so many factors that go into that equation and what it would cost.
And I think we're going through these examples, the ones you've seen, and there are, I'm sure you could go through example after example, but the best thing to do, it doesn't, look, if somebody calls you and says, hey, Shannon, Alyssa, I'm interested in long-term care insurance. What happens? Do they have to pay you money? Do you just look at it? Tell me what happens.
We really evaluate their needs. We look at holistically, can they afford it? That's the biggest thing. Can you afford to buy care? Yes, it's nice to have long-term care insurance, but if it's going to drain your retirement assets to do it, your first and foremost goal and concern is to make sure that you're not going to outlive your money. Beyond that, we can look at long-term care insurance as an addition to fill an additional gap, but usually it's a secondary thing to making sure that your retirement expenses are at least met first. So there are so many factors that go into how we address it and how we look at it for each individual circumstance.
That initial consultation meeting is always complimentary. I think, what you've seen with Alyssa going through these examples is there's tons of different ways to fulfill these needs. And the other thing I would add is that the insurance landscape, if you will, is always changing. So insurance providers are always changing their benefits, what products are available. It's our job to stay on top of that. But that creates these opportunities for policies that you may have had for years. Hey, let's evaluate those policies, make sure that you really understand the benefits. And if there's potentially a better option for you to be, utilizing the cash value, for example, in an existing policy, we're happy to look over those, your current documents on a complimentary basis, just to see if there's a way we might be able to help.
And then Kathy asks, can you address health and viability of the long-term care industry? It's kind of interesting. I'm not sure if that means insurance. I would say that insurance is a regulated space. The long-term care industry is also another heavily regulated space. A lot of people are paying attention to this. We have this slug of baby boomers that's going to go through this phase of life. So the health of the industry, Shannon and Alyssa, you can answer that question, but I would say it's a heavily regulated space. So I would say it's
typically for every dollar of insurance that an insurance carrier provides, they have to have $2 in the bank to do it. So they have cash reserves in order to insure and to be able to substantiate these claims. And to Shannon's point, carriers are always changing their costs. And the reason, the way that they do that is if they have a specific age that they're insuring, and a lot of those people are passing away, they need to essentially make insurance cheaper for all the younger people that they're gonna pay their premiums for a really long time. They're young and healthy. They know that they're gonna collect premiums before having any claims payments made. So the carriers are constantly looking at their book of business and when claims are gonna get paid out. And if they have a big age, if there's an age group that's particularly needing claims paid out for them, they will essentially make insurance cheaper because they need to recoup that cost. And so they're really healthy. There's always these algorithms in the way that they look at their overall book of insurance and claims to make sure that they're able to cover those costs.
I would also say there's something else called reinsurance, where an insurance company will go to another bigger company to insure their liabilities. So you updated your question with specifically the insurance, the long-term care insurance industry. I think if I were watching this and I had a CalPERS policy, I'd be like, well, wait a minute, CalPERS really, blew it, and they did. And I think the industry collectively has learned a lot from that. And that's kind of what I think the industry did learn a lot from CalPERS, offering something very early with very generous benefits that they didn't have enough money to pay claims as a bottom line.
Right.
All right, so let's cover this. Let's a male age 65. $1,000 a month for 10 years. So this is a pay $1,000 for 10 years, right?
Pay as you go. So this just kind of goes back. There's so many different ways to do this and fund this, and make sure that you actually have a way to recover some of those premiums if you were to pass away. So it's not necessarily the use it or lose it old model. There is a death benefit associated with this if you were to pass away. Return of premium is $84,000 if you put in 120, and you're essentially going to get potentially $4,600 a month in care. This is another one of those that essentially runs out a little over 2 years if you have it. This particular policy is on an annuity chassis, meaning anything that's on an annuity chassis is essentially easier to insure. So if you have maybe some health complications and you're worried about qualifying for life insurance, there may be potential to still get you long-term care depending on what your ailments are and what your health history says. But an annuity allows a little more flexibility than particularly a life insurance underwriting process.
And here's our information for those of you who would like to reach out. And Anita asks if you're having to take RMDs now, is what I meant. May it be wise to use the RMD to purchase long-term care insurance? Anita, sure, but I think those things are happening independently. So if you're in RMDs, you have to take the money out of the left pocket, put it in the right pocket, and that's just the world you live in. Yeah, you could certainly use some of that money. And there's some other things, frankly, that Shannon and Alyssa and our firm can do to mitigate income tax. So for those of you who are doing like a Roth conversion, there are a lot of things that you can do typically over the arc of a period of few years where you can really mitigate the taxes that would otherwise be paid. Joy asks, sorry, wouldn't the strip IRA be better because you don't have to rely on the reliability of an insurance company? Joy, perhaps, but again, this is more of a self-insurance model. And for those of you, there are two camps. Those are the people who say, hey, I'm going to self-insure. Great. Those are people who say, I don't have peace of mind. I can't sleep at night. I'm worried, that my wife's one of these, like, we need to get long-term care insurance. You saw what happened to my parents. I don't want to be a burden to my kids like my parents were a burden to me. And really, it's fundamentally, I think, a peace of mind issue.
The biggest thing there would be leverage.
Yeah, and leverage too, because you put in a small, and if there's a need, you're getting a little bit bigger. Of course, there's a cost associated with that. So this is, and again, an individual decision. Linda asks, I'm 73. I don't have life insurance as I never had children. I've had long-term care insurance through MetLife since age 54. It jumped from $2,900 a year to $3,800 this year. Would I benefit from taking out one of these life insurance policies now with the long-term care benefit? Linda, great question. Talk to Shannon, talk to Alyssa. They can go over that with you. But this is exactly here. This is really the problem with the pay-as-you-go is they raise the premium. That really is the fundamental problem. Like you're retired, you're living essentially on a fixed income, and now they raise it by 50%. That's just not fair. All right, I'll get off my soapbox. All right, so when you call us, this is if you call them, you're going to probably talk to Shannon and Alyssa or Christina. If you call Ascent, if you call us, you're going to talk to one of our client specialists. You're not going to talk. The lawyers don't pick up the phone. It's not the FBI. Let us know if you want to update or create an estate plan. or if someone's passed away, because that's kind of the fork in the road for us, or maybe someone's gotten sick or has Alzheimer's or something like that. Tell us your goals. Tell us why you're calling. I'm calling because, and that's very helpful. Don't ask for pricing. Only lawyers can quote legal fees, and don't ask for legal advice because only lawyers can dispense with legal advice. And the purpose of this initial call, if you do call in, is to set an appointment with an attorney. If you're watching this on YouTube, please click subscribe and click the little bell on there, because you will be alerted when stuff is hits YouTube, which is typically 6 p.m. Pacific time every Thursday. And if you enjoy one of our webinars, please write a review on Google. We are having an in-person event in Auburn, California, not Auburn, Washington, or Auburn, Alabama, March 3rd, 2023, which is in Northern California between Sacramento and Tahoe. Beautiful area. And we're going to be going over all things, hey, do you need to update your estate plan? What's happened in the world? We also have Daniel Van Slyke next week. LLC versus corporation, which is best for your business? It's like a little bit of a boxing match, right? LLC versus corporation. I will be on vacation, and Daniel will be pinch hitting for me. And that brings us to the end of our materials here. We do have we have the links for the upcoming webinar and workshop in the notes here for those watching, and in the notes on YouTube. So we're going to end this webinar, but don't click anything, because right after this webinar is another video that's going to start on our YouTube channel. So